This is the road to $1 million, a series where I document my journey in the stock market, giving you monthly updates of the buys and sells, the portfolio performance, the dividend income, and the plans for the future of how I'm going to get this portfolio to $1 million. Pretty self-explanatory, but I'm gonna try to make $1 million. The goal is to document a realistic journey in the stock market, none of that day trading penny stocks, making $10 million a day, just the real process of building wealth slowly in the stock market. If you're interested, do not forget to smash the like button and subscribe because we do this every single month, along with a lot of other great content to improve your relationship with money and have you building wealth faster. Jumping right into it, my self-managed portfolio is actually down $5,900 or 3.62% in the last month. If you look at the 3-month chart, it's not better. It's down $7,000 or 4.13%. This is because of President Trump's trade wars against their biggest trading partners, along with other uncertainty in the crypto market and the stock market in general. But in these times where you might be scared of uncertainty, it's good to zoom out. If you look at the 6-month chart in this portfolio, it is up $10,000 or 7%, and the 1-year chart is even better at a gain of 12% or $17,000. Zooming out is extremely important, not just for this portfolio, but for your portfolio as well. Any long-term investor needs to look at the long-term horizon of 20 years or 30 years. Do not look at the 3-month chart and be scared. If your portfolio is performing well and the market is performing well in the long run, that is the only thing you should be concerned about. Now we'll jump into the portfolio composition. What did I actually buy for this portfolio and what are some of the biggest holdings? My biggest holding is the S&P 500 through this ETF VFV. You don't have to buy Vanguard products. You can buy BlackRock. You can buy any ETF provider that you like if you're interested in the S&P 500. As you can see, I have nearly $50,000 now in the S&P 500. That sounds ridiculous when you say it out loud, and this has returned me 27% or a grand total of around $10,000. I buy the S&P 500 every single week, as you can see, January, February, March, today. I've just been buying the S&P 500 at a weekly cadence because I believe in the long-term potential of the US market. The S&P 500 is an index that tracks the 500 biggest companies in the United States of America. Technology, financials, healthcare, consumer goods, any industry that you can think of is included in the S&P 500. Historically, this index has returned 10% on average for the last 40 years, and I think it's going to return 10% on average for the next 40 years as well, simply because the US economy is robust, the biggest companies operate out of America, and they have international exposure. Apple is not just sold in the US, it's sold in literally all continents. Microsoft Office is used not just in US offices, but in international offices throughout the world. Google Search is not just used in US, it's used in Africa. Somebody in Rwanda is using Google Search as well. I can go on and on, but the point is that if you invest in the S&P 500, you're investing in 500 companies that have international exposure, not just US exposure. Even though in the past 3 months, you can see this has a negative return, the past year has been excellent at around 19%, and the past 5 years have been excellent as well at around 100%. This $45,000, I hope to bump this up to $100,000 eventually. Not this year, but eventually down the line. I believe in the S&P 500, I believe in the US market, and if you do as well, you might want to look at the S&P 500. My other biggest US ETF holding is the NASDAQ 100 through this ETF HXQ. Once again, you can buy any ETF provider that you like. You don't have to buy Global X. The NASDAQ 100, much like the S&P 500, holds 100 of the biggest companies in the United States of America. One thing to note about this ETF that it's majorly tech focused. Tech companies have returned the most value in the past decade. Companies like Apple, Amazon, Microsoft, Google, and so on have quadrupled their market cap in the last 2 decades. If you think tech is not going to return similarly in the future, you might want to stay away from the NASDAQ 100. You can see the 5-year chart is specifically nutty for this ETF. It's returned 156%. I'm not saying this return is indicative of future returns, but I do think tech has the most amount of value to add. Look at any futuristic industry like AI, robotics and automation, you name it. Anything that you can think of probably has technology in it. Companies like Apple, Microsoft, Google are specifically well positioned to take advantage of this growth. So I buy the NASDAQ 100 every single month. You can see in February, I bought it twice and today as well. So 3 times in the past month, I bought the NASDAQ 100. Solid growth potential, solid diversification in my opinion, and I'm going to keep on adding to the NASDAQ 100. Moving on from ETFs, Apple remains my biggest holding in terms of individual companies, returned solid 36% in the last year. I'm up 38.7%. My holdings are roughly $7,000. I think Apple is going to have steady growth in the future. The iPhone market is still expanding in developing countries. They have to figure out some challenges with China and other developing economies, but I think the brand recognition and the brand image that Apple has established is going to pay off in the long run. This is not a 2-year play, this is a 10, 20-year play. The smartphone still dominates our lives, and I don't see this changing in the next few decades. Any app that you access through your smartphone, and now smartphones are becoming even more important in digital banking as well. So if you pay on Apple Pay, you're paying through your smartphone. This intertwining of the financial ecosystem with the Apple ecosystem, I just don't see this going away anytime soon. This is just going to get even worse when it comes to the entanglement, but better for Apple's shareholders, which is why I continue to invest in Apple. My next biggest individual holding is Microsoft. Microsoft, as you can see, has been beaten down in the last year, down 7% compared to the growth of Apple that we saw at 38%, although I am still up on Microsoft 6% all time. Microsoft has somehow fumbled the AI bag. They haven't figured out how to integrate OpenAI and ChatGPT into their Azure division succinctly, and the CEO, Satya Nadella, is also now saying that AI perhaps does not add enough value as we once thought. They've decreased their investment in data centers, which also signals that they're perhaps not as bullish on AI as other companies, and as we know, AI is the next big buzzword. Every company is looking to invest in AI, and the market has had a negative reaction. Although I want to zoom out a bit and look at the 5-year chart for Microsoft, which has returned 128%, and specifically I want to look at the net income that Microsoft generates. The Azure division is still growing exponentially. Microsoft products are still very sticky, specifically the Microsoft Office suite. And as long as Microsoft can keep on expanding net income, keep on expanding margins, and keep on expanding the dividend that it generates as well, it is still an attractive holding. The only problem it's going to have is integrating OpenAI's products into its own Azure division, but as long as it can do that, I think Microsoft is going to be a solid holding for the future. My third biggest individual company holding is Google, ticker symbol Google. I actually bought this past month. I added 1 share of Google because I do believe at these multiples, it is impossible to ignore. It has a PE ratio of 21. The market seems to think that Google is not going to be a good growth company in the future, but I disagree. I disagree quite strongly. Google has an extremely wide variety of products, specifically in its search division, its Gemini division with its AI products, and hardware as well now with its Pixel products. Not to mention YouTube and social media that we all love to consume. Google is a market leader in all of these, and the most important thing for me is that it has the most amount of data. AI is the next big thing, and if Google can show that it can harvest this data somehow and integrate it onto its Gemini products, it is going to see a tremendous gain from this. The return has been solid, around 10%, but I think at this multiple of 21, Google is just a very attractive buy. It is almost half the multiple of Apple or a Microsoft or a Tesla. So I just don't think I can ignore it at this price. Obviously a long-term play, obviously believing in Google products like the cloud division, Gemini, and Google Pixel. Let's see if it pays off, but I think at this multiple, even if it doesn't, I would be very content with my decision to buy and add on to Google. One of the other individual holdings that I added onto is Fortinet, ticker symbol FTNT. This is a cybersecurity company that has done extremely well for me, having returned 40% since I started investing. If you look at the 5-year chart, it's absolutely insane at 400%. The 1-year chart is good as well at around 50%. But I think Fortinet is a play for the long run. Fortinet is a cybersecurity company that provides end-to-end protection for a company's business. Firewalls, threat detection, network protection. Fortinet has a product for literally anything that you can think of for your cybersecurity needs. The one thing that I like about Fortinet is that it's figured out a niche in the market for itself. The growth rate is steady at around 13 to 15%, but the profit margin is absolutely insane at 30%. For other SaaS companies, particularly B2B SaaS, they struggle with establishing a profitable growth strategy. Fortinet has figured this out. It has a 15% growth rate, it has a 30% profit margin. Just combine that with the boom in the cybersecurity market in the coming 20, 30 years, I think it's positioned to be a market leader. And that's why I added on to Fortinet. I bought a share in January. I also bought a share today. So I'm just going to keep on adding on to Fortinet because I think the expansion possibility, given the profit margin, is extremely good. So those are my US focused companies and buys. I also have a portion of my portfolio dedicated to covered calls. Covered calls are extremely controversial online. People want to fight each other and really hit each other hard, taking one side or the other. They sacrifice some long-term potential growth to give you income now because they write call options on a percentage or all of the portfolio. I think covered calls are a good way to keep motivated to keep on investing. That's the primary reason why I invest in covered call ETFs. I don't invest a lot of money, as you'll see with my holdings, just enough to keep me motivated. My biggest holding is HYLD. This is a Hamilton ETFs product tracking the S&P 500 pretty much. I have around $9,000 invested. It is up 1.77% all time, and I do add to this every single week, literally every single week, because I believe in the long-term motivation that it'll provide me. The primary reason for buying covered call ETFs is this tremendous yield, around 13.5%. The yield of the S&P 500 is around 1%. This is almost 14 times that. I understand that the return is not the same even if you add on the dividend income, but the motivation factor I get seeing this dividend income pile up is just not replicable for any other ETF that I own. Now I get paid around $100 every single month from HYLD, a tremendous amount, and I'm going to keep on adding on to this. The underlying holdings are some holdings that I really love, and this ETF also doesn't write call options on 100% of the holdings, which I appreciate. I can still take part in some of that long-term growth. Pairing with my S&P 500 covered call ETF, I have a NASDAQ covered call ETF, QQCL. Once again, the underlying thesis is to take part in that nice yield. As you'll see, this ETF has a yield of 13.42%. Absolutely bonkers compared to the negligible yield of the NASDAQ 100. Not a lot of money invested, around $2,700. I'm down on this position, but if you add the dividend yield, of course I am up when it comes to total return. I'll keep on adding to these positions as long as I can keep them below 15% of the entire value of my portfolio. So that's it for my US ETF and company buys. I also have a percentage of my portfolio dedicated to Canadian buys. I live in Canada, home of maple, home of polar bears, not home of the handsome Prime Minister, unfortunately. So I do want the Canadian economy to do well, and I want to partake in it to be a nice citizen. My biggest position and number one buy is always VDY, the Vanguard FTSE Canadian High Yield Dividend Paying ETF. This tracks pretty much the TSX 60 or the 60 biggest companies in Canada. Banks, insurance, healthcare, energy companies, all of the oligopolies that I love and adore in Canada are included in this ETF. It has a nice performance at around 12% for the year. I am up 10% all time in this portfolio, but I buy this primarily for this nice dividend yield. A return of 4.3% on every single dollar invested is tremendous compared to the dividend yield the US market has. And that is why I add on to this every single week. February, I bought this every single week. Today, I bought this. I think Canada has tremendous opportunities for the future, specifically because it has a large amount of natural resources. The ability to attract skilled immigrants is also a factor that I think is going to help Canada out in the long run. Just very bullish on its ability to harness these resources and create stock market value, which is the most important thing for me. I don't know if it should be, but it is. I pair my VDY, the Canadian ETF buy, with a covered call Canadian ETF called HTID. This is a Hamilton ETFs product tracking the Canadian market. As you can see, it is up 5% in the last year, not bad. I am up 6% on my holdings, roughly $7,000 invested here, but I buy this primarily for this juicy yield of 12.3%. This is 3 times the yield of VDY, the Canadian ETF that I hold. The underlying holdings are the same: Canadian financials, Canadian banking, Canadian energy, Canadian healthcare, and Canadian utilities, but I get that boost in yield since they write call options on all of those holdings. I believe in the underlying holdings. I like this yield. Not too much money invested. As you can see, only $7,000 compared to my $26,000 in VDY, but just enough to keep me motivated. The last buy that I want to talk about is HEQL. This is a Global X product that is an all equity leverage ETF. As you'll notice, my portfolio is majorly US and Canada focused. All equity means that this ETF holds not just the US and Canadian markets, it also has international exposure at around 30%. This is my way of partaking in the international economy. Leverage means that this ETF's returns are going to be magnified. If the underlying holdings go up 10%, this ETF is going to go up 12.5% since it has 25% leverage. But the opposite is also true though. If the underlying holdings go down 10%, this ETF is going to go down 12.5%, plus leverage costs or the cost of interest that the ETF provider has to pay. You can see the pros and cons here. For a younger investor like myself, or if you're in your 30s and 40s, I think slight, modest leverage can add on to your returns and magnify them. I believe in the overall stock market of the world, particularly the US and the Canadian stock market. I want my returns to be magnified. And you'll see, I buy this pretty much every single week. I bought this in February, every single week, literally. I also bought this today, right before I filmed this video. And the yield is also not bad, at around 2%. The pros are all there, the leverage is going to add on to the returns, and I'm going to hopefully turn this near $5,000 here to $10,000 somewhere along the line. Moving on to my favorite section of the video, and maybe your favorite section as well. Let me know what your favorite section is in the comments. The dividend section. This portfolio now pays me $5,166 every single year. I get paid around $430 a month, which turns out to $14 a day. Wow. The yield on cost is 3.72% and the yield is 3.27%, which basically means that my portfolio has gone up in value with the price appreciation as we've seen in the breakdown. In February, I got paid $366.45. The 45 cents is extremely important. Do not forget that. And my biggest pairs are HYLD, the cover call ETF tracking the S&P 500, VDY, the ETF tracking the Canadian market, HDIV, the covered call ETF tracking the Canadian market, and VFP, the S&P 500 ETF, along with QQCL, the covered call ETF tracking the NASDAQ 100. You can see my strategy here. Most of my dividends are generated from ETFs that I can then reinvest to buy more shares of the same ETF or buy other assets. HYLD and VDY in particular are huge pairs for me, now paying me $1,200 and $1,100 respectively for just buying and holding on to stocks. Just think about it. Just think about it a bit. You're getting paid for doing pretty much nothing. Pepsi and P&G are also good pairs at around $150 on average, combining the two of them. But tech companies don't pay me enough right now, like Microsoft, Apple, Google are not paying a lot in dividends. The goal though is to keep on adding, so 10-20 years down the line when Microsoft, Apple, and Google, amongst other tech companies, increase their dividends, I'm going to be positioned to take advantage of that and add on to this income. Apple right now pays $40. Who knows? Maybe it's going to start paying $100 5-10 years down the line. I just want to be positioned to take advantage of that. Just to illustrate, I can buy one of these things from the dividend income I earned last month. For example, I can buy a Square terminal just in case I want to set up a coffee shop, leave corporate America behind, and live happily ever after. I'm not saying I'm going to do that. Maybe I will. Who knows? Maybe you'll never hear from me again. You can do whatever you want with this dividend income. I choose to reinvest and grow my portfolio even further. I just think it's very powerful that I can buy real tangible things from investing in the stock market. Thumbs up. I know the title of the video is not incorrect. I also have a work managed RRSP that I include in these numbers. Employers in the US and Canada offer retirement matching. You put a percentage towards your retirement and they match it. Employers can do this up to 5, 6, or even sometimes 7%. I partake in this. I put 4% and my employer matches 4% to give me a nice investment amount of 8%. My managed portfolio now is up to nearly $31,000. I put in around $12,000 and my employer has matched around $12,000 with a modest growth of $5,600. I think of this as investing $12,000 and making nearly $18,000. Not a bad return for an average investor like myself. You get an automatic 100% return just through the match alone. I highly recommend looking at taking part in this because especially for average investors like myself, this is a good return. 100% on any investment is a good return. So that's it for this week's portfolio review. Road to a Million is still alive and well, although we've seen some bumps along the way. The goal is to keep consistent, keep investing, and partake in those big gain days as well, not just those big loss days that we've seen in the last month. As always, if you enjoyed this video, smash the like button and do not forget to subscribe. Every subscriber matters and helps get this video to the right people, also interested in investing, saving, and learning to grow wealth. I'll see you in the next one.